Alrighty. So in today's video, I want to introduce to you the concept of what I call the income grid option trading methodology. And the reason for this is that it helps solves one of the biggest and most pressing questions that I get, and that is knowing where and when to enter into trades, right? So I've got a number of people who will reach out to me, ask me, Davis, when should I enter into a trade, right? When should I enter into a credit spread? When should I enter into an iron condor? Or when's the best time to get into a trade? Or how do I know if it's time to enter into a trade or if I should wait? So this is one of the questions that I get quite a bit, and that is why I want to introduce to you this concept. Because if you were to take a look at the chart, right? If you were just to open up the chart of any stocks that you have, like in this case, this is the index ETF, the Russell 2000 ETF. So at this point of time, you might be wondering to yourself, what kind of trade should I put? Right? Should I put a bullish trade, a bearish trade, neutral trade, or should I even enter a trade right now? Right? You have no idea what to do. So one of the things that most people do is that they'll basically read chart patterns, right? Maybe they will do head and shoulders, right? They will see a head and shoulders pattern, they will see it's a reversal pattern, or they may look into, candlestick patterns, or some will just look into support and resistance levels, or maybe even technical indicators. So all this can get pretty confusing, especially when you're just starting out. And the truth of it is that you actually do not really need to study into all this, because one of the things is that we don't even really know how effective it is, right? And the other thing is that when you're entering into an option trade, unlike just normal trading, normal trading is when you just buy and sell at the market price. You have no idea what's the percentage that it will work out, right? But whereas for trading options, you already have the embedded probability of profit into the strategy, where you already know what is the probability of chances that you will win on that trade upfront, right? So when you already know the probabilities upfront, all you need to do is just decide where you're going to enter into the trade, right? When you're going to enter into the trade. So one of the ways that it's easy for you to identify this would be using the income grid, right? So this is what I call the income grid option trading methodology. So basically what it is to just grid the chart by drawing lines at every fixed dollar interval. So as you can see for this, I just drew like these lines down here that is about $5 apart from each other. Okay, so all you do is that when you draw this line, suddenly it makes it so much easier for you to see the chart, right? You know what are the different price levels, and then at each of these lines, this grid, right, it serves as levels where you can identify option trading opportunities. Right, so let's say, for example, you don't have any positions down here, then you can just say, all right, at each of this level, there's some kind of opportunity that can present itself, right? So what you do is you will wait until it comes to this level, then you'll say, all right, so at this point of time, I can choose to either place a trade or not place a trade. So when you have it in this way, right, basically what you do is that you have many different trades at many different levels, right, with differing strategies as well. So if you were to watch my previous videos, right, some of my videos I mentioned that I have many trades on an individual stock, right? Most of the time will be on index ETFs. So what I do is that I will have all these levels, and each of these levels I'll decide whether I want to place a trade or not, right? So most of the time I always have some kind of trade at each of these levels, right? So when I have trades at each of these different levels, I have some sort of an inbuilt diversification inside, which is a very important thing that you have to understand, because when you have trades with different strategies at different levels, it is one of the best defenses against market crashes. You see, when it comes to diversification, and I'm sure you heard about the term diversification, right? You want to diversify your portfolio into different stocks. Most of the time, that's the most common way, where you basically just trade different stocks, right? So this is what you call horizontal diversification. So I'm going to share with you the difference between horizontal diversification versus vertical diversification. So horizontal diversification is basically you open up the chart, right? So this is basically the routine of what most people do when they trade the markets, right? On each day or any given day, they will just open up, their charts. They'll have a watch list, and they'll go through each of their charts to find trading opportunities, right? So let's say, for example, on Nike, they open a chart on Nike and they look at the chart and say, look at this, it's bouncing off the moving average, so they have a bullish view. So what they do, maybe they sell a bull put spread, right, which is a vertical spread, a credit spread. So you have a short put and then you have a put option which you buy back. So this is the bull put spread. And then they open up the Starbucks chart and then they see that, oh, the market has sold off quite a bit and it looks a little bit bullish because there is this support below. So what they're going to do is they're going to sell another bull put spread again. So now you have two trades on two different stocks. And then they open up a third one and then they say, oh, this is Disney. Look at Disney. Disney also is pretty oversold. So at this point of time, they may say, all right, I also want to sell another bull put spread down here. So in this way, you have what you call horizontal diversification because you have strategies on each of these different stocks, right? So what we are trying to achieve, or what diversification really is trying to achieve, is to have different P&Ls at the end of the day where it's not correlated. So let's say, for example, you have enough capital to place 3 credit spreads, right? Let's say 3 bull put spread. So the consensus is that it is better for you to place 3 different bull put spreads on the 3 different stocks compared to just one stock and then you have 3 bull put spread. Correct? So this way you have sort of a diversification. So in the case, maybe this one may go up or this one will go down, then this one maybe will just crash. So this way you will make money on this one, you will probably break even on this, but this one maybe you will lose money, and then you have your P&L somewhat diversified, right? But the problem with horizontal diversification is that most people tend to enter them around the same time. And by same time, meaning on the same day or in the same week, right? So when you do this, although there is some diversification in terms of the different stocks, right? You have Nike, Starbucks, and Walt Disney. They are pretty much in different sectors. But the problem is that when the market crashes, everything will crash at the same time. They will all start going down and they will all test your bull put spread. And you see this is what actually happened during the crash during the pandemic and also in 2022, right? So if you have a number of positions on sometime towards the end of 2021, you will notice that a lot of your bullish positions will get tested, right? So if you were to put on these 3, then guess what? All these 3 will start to crash and we will pretty much go through a lot of your bull put spread in this case if you have them on. So the other way is called vertical diversification. So instead of using different stocks and putting all the positions at the same time, instead what you might consider doing is putting it on an index ETF. Right, in this case, this is the Russell 2000 ETF. So this way you're not prone to individual stocks, right? Individual stocks are much more prone to individual stock news whereby there's going to be a sudden news where it's going to be gap up or gap down. So that is why I prefer the index ETF. And then for this, what you want to do is plot what I call income grid, right? So you have all these different price levels. So instead of entering all at the same time, what you want to do instead is to enter based on different price levels, right? So each time when the price hits any of this line, you can actually choose to enter into a trade, right? It can be a bullish, bearish, or a neutral trade. So let's say, for example, we use the example of the bull put spread, right? As we have used in the previous slide where you use 3 different stocks. So for example, in this case, let's say you saw that the market has already sold off quite a bit and it's pretty overextended. So now you want to get a little bit bullish. So maybe you are considering enter the bull put spread, which is the put credit spread. So you might be saying to yourself, all right, so once the market comes all the way down to this price level, 175, when it touches 175, I'm going to enter into a bull put spread, right? So if you enter into a bull put spread, maybe it will be somewhere down here, right? Now, at this point of time, right, if you will compare to the horizontal diversification, you would already have 3 bull put spreads on, right? But instead for this vertical diversification, you just have 1 first, right? Because you want to go according to price levels. That means to say, let's say if the market drops again to 170, then you're going to initiate another bull put spread. So what this does is that you're actually diversifying in terms of price level and also by different timing, right? Because maybe a couple of days have gone or maybe a week has gone from from 175 to 170. So at this time, you may be entering into a different tenure, a maturity date for your options, right? It could be a different DTE. So maybe when you enter this is 45 DTE. Now, once the price, let's say for example, goes from 175 to 170, let's say a week has passed, right? So a week has passed, so you're no longer able to go on the 45 DTE the same, because this by that time would have already become somewhere around 38 DTE. And ideally, my preference is to go around 45 DTE and above, right? To around 60 odd DTE. So I wouldn't go for this at this point of time when it goes to 170. So I will go for the next nearest 45 DTE to 65 DTE, right? And then, so what this means is that this will be a new DTE compared to the previous one. So you can see right now you have diversification in terms of different strikes, right? And you also have different time, right? Different maturity dates, so they will expire at different dates. So this way you really have a much smoother P&L. So each one has their own theta effect, right? So this way, when the price actually rebounds, right, if it goes back up again, you will have a very differing P&Ls, right? Compared to if you have the horizontal diversification, you're going to get all hit at the same time. So that is why with vertical diversification, right, it is my preference compared to, having many different stocks and then you are just, entering pretty much the same position on all of them, right? So in this case, with vertical diversification, right, you can diversify with different price level, different strike prices, different expiration dates, and different strategies. So the result is that you will get a smoother P&L with the income grid methodology. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. All right, so let's get into the income grid option trading methodology. So at each level, you have 4 choices. So the first choice is to place a bullish option strategy, right? So let's say, for example, down here, you could see that the price level has been hit, 175 has been hit. So this is where you can choose to place a strategy. Now you could choose to place a bullish strategy, and that could be a short put, all right, could be a bull put spread, could be a put ratio spread, could be a put broken wing butterfly, could be a debit spread, which is the bull call spread, right? So for the put ratio spread, it's pretty unique because this is an omnidirectional trading strategy. That means that you can adjust it so that you're slightly more bullish, or you can adjust it so that you're slightly more bearish, or you can adjust it so you're more neutral, right? It really up to you to manage the strikes. But basically, you can place any of this bullish strategy when it comes to this level. Now, the next choice is that you could place a bearish strategy. So you might think that, oh, it is coming here, it looks like it's consolidating, and looks like it might push further down. So in this case, you might want to place a bearish strategy instead of a bullish strategy. So you can place either a bear call spread, a bear put spread, a put diagonal spread, a call broken wing butterfly, or a put ratio spread as well. So as you can see, there are many different strategies that you can choose to place when it comes to one of these levels. Or you could just choose to place a neutral strategy if you're just not sure what it's going to do. So if you do not have a bullish view, you do not have a bearish view, then you can just choose to place a neutral strategy, right? And there are many options as well. You can choose to place the Iron Condor, you can choose to place the Jade Lizard, you can choose to place the Strangle, you can choose to put the put ratio spread, or you could use the Butterfly or the Iron Fly. So as you can see, there are many different ways that you can enter into a neutral strategy, and really comes down to you which one you want to place. And that is the third choice. And the fourth choice, of course, is that you can just simply do nothing, right? There is no pressure for you to put on a trade, right? For example, you could see that, the market has come down to this point down here. I don't feel like I want to enter into a trade yet because I don't have a bullish view, I don't have a bearish view, I don't have a neutral view. So what I want to do is I just want to wait and see, right? Maybe if the price goes down to this level, then I will say, all right, then I will start to get bullish, then I will place a bullish strategy. Or if the market trades back up to this price, then you could say, all right, it looks like it's going sideways, then I want to place a neutral strategy. So basically, when you have this income grid down here, it eliminates the problem or the issue of wondering when to enter into a trade, right? So as long as the prices have reached any of this level, you can do something. So for me personally, I do have a trade at each of this level. So I'll either place a bullish trade, a bearish trade, or a neutral strategy. So this way, I will always be extracting some sort of extrinsic value. So for yourself, if you do not have that large of a capital, you can pick your places, right? You can pick where you want to enter into a trade. So maybe you could see that, all right, I want to only enter into a trade if the price have moved 2 levels, right? For example, from down here, let's say it goes up 2 levels, from here, 1 level, 2 level, then at this point, I will choose to enter into a trade. So at this point, maybe you say that it's in between the support and resistance levels. So this is where I think that the market could be going sideways. So if it's going sideways, then you can place a neutral strategy like the iron condor, or maybe even the strangle if you have the capital. And if it starts to go up even further, right, it goes another 2 levels up, then it's approaching this resistance level, then you could say, all right, now I want to get a little bit bearish because it seems like the move has been a little bit overextended and I want to get into a bearish strategy. So this way you have a neutral strategy like the iron condor going on, and then down here you have maybe a bear call spread going on. So this way you have different strategies at different timings, different strike prices, and different maturity dates of the expiration, and this will really give you a much better way to enter into the market, right? A better diversification than if you were to do just horizontal diversification and just put a single trade at each stock. So what's most important, that when you enter into your trades, you want to have the proper capital allocation as well. As mentioned before in many of my other videos, you want to keep your capital allocation at most to 5 to 7% of your capital. And you do not want to have more than 50% of your capital at risk at any one time. So let's say, for example, if you were to put on a trade that is 5% risk, let's say, for example, at this level, 175, you have 5%, you risk 5% here, then it goes to 180, you risk another 5%, and then it goes down here again, you risk another 5%, and then basically you can have trades up to 10 trades at a time. And if you do want to trade a single product, I would strongly suggest that it will be the index ETFs. It's less volatile and you do not have to be exposed to individual stock issues or problems, like for example bad earnings, or maybe like the Silicon Valley Bank kind of situation where it goes bankrupt, right? With index ETF, it's not as volatile and you can always put on trades because there's no such thing as earnings, so you can always try to extract extrinsic value every single day. So to just very quickly sum things up for you, the income grid option trading methodology is a way for you to easily identify opportunities on your chart, right, where you should enter into a trade. So each of this level presents an opportunity to you where you have 4 choices, right? You can either place a bullish strategy, a bearish strategy, or a neutral strategy, or you can simply just do nothing at all. So basically, when you use the income grid option trading methodology, you're going to have different trading strategies, you're going to have different price levels where you enter these strategies, you're going to have different strike prices of each of these strategies, and you're going to have different maturity dates, different DTEs for each of these strategies, which is a very good way to diversify your options portfolio. Alright guys, that's it for this video, and I hope you found this video helpful. And if you like this video, please give me a thumbs up and also subscribe to my channel as well. This way I can create more videos like this for you. And last but not least, thank you for watching. I appreciate your time, and may the options favor you.